Alright, next it looks like we have myth number 3. Momentum is much stronger among small cap stocks than large cap stocks. And the authors note they usually hear this as the extreme, that momentum only exists among small stocks. And they note that it's typically something that's said by proponents of value stocks, but in the case of value stocks, the same occurrence happens where value returns are weaker in large caps. So anyway, let's get into some of the details of this. And the most recent detailed study around this is Israel and Moskowitz in 2013, where they find that there's little to no difference in the momentum returns related to size. So the momentum returns of small caps are just as large as the momentum returns of large caps. But to sort of make a cut at the value investors here, they make note that the value premium is strong among small caps, but virtually non-existent among large caps. So, like the other myths, authors are going to dig into Kim French's data and try to replicate some of the previous studies or form their own results. And so they use these results in Table 5, where they're going to look at the UMB small, and that'll be the returns of the past winners minus the returns of the past losers, only among small stocks. And then the same thing among UMB, where they're using only large cap stocks with the returns of the past winners minus the returns of the past losers. And they do the same thing across all the stocks, both small and large. And it looks like they're also going to do the same thing for high minus low, which will be the value versus growth stocks, to see how size relates to value returns. So let's take a look at the data here. So here we have so the UMD small, that will be the momentum strategy of small caps only, UMD big, the momentum strategy of large caps only, and then UMD, which would be across all sizes of stocks. And we see here that small companies tend to have a larger momentum return than the large cap companies, but it's a small difference. And the large cap UMD is fairly large return. Comparing it to the value strategy of the high minus low small cap and high minus low large cap, we see there's a significant difference in returns as well over these different time periods. And even in the out of sample period for the 91 to 2013, we see the high minus low for large caps is nearly zero. So, and the authors note here that actually this high minus low large caps is not significantly different from zero once you take into account the market beta. And they make note that here in the momentum strategies, both of these are statistically significant. And so to sum that up, it seems like the momentum strategies significantly outperform the value strategies when taken separately. But we're going to dig a little deeper here. And the authors make note here that when Fama and French came up with the high minus low strategy back in their papers, I think it was 1993, they purposely split the stocks into to make it be half large and half small cap, and that way, half of the high book to price would be large, half would be small cap, and then for the low book to price, half would be large and half would be small caps. And so they make note that practically in the real world it would be really tough to short a bunch of small stocks, and that would be in the large or the low piece. And so they make note that if Fama and French back in '93 didn't make this specification to normalize for size, probably most of and they would have only used large cap stocks, then they probably would have found no value premium at all. And this is kind of a similar result as what we found in '91 to 2013, where the high minus low of large caps is statistically zero, and with a Sharpe ratio of 0.06. However, for the UMD momentum strategy, the Sharpe ratio was 0.24, and in small caps was 0.45. And so we can conclude that momentum, when comparing it to value, is a lot more robust among large caps than small caps. And so the authors note that, or they reference the papers that contributed to these myths, and these two papers here, which one of them is an author of the paper we're reading right now. And really the difference is kind of a difference in time periods. It looks like the previous authors looked at the 80s and 90s, whereas for the paper we're reading right now, the period goes back all the way to 1927. And so maybe the previous papers that expounded these myths maybe had too limited of a sample period. And the authors note here that the previous authors never really claimed that momentum was non-existent among large caps or on the long side. It just so happened that the declarations were twisted into more of an extreme view. And so, and we did find, or the authors here did find, that in the '91 to 2013 period, small caps did perform better than large caps, but large caps still had a fairly good return using these strategies, and a better return than the value strategy. And as further evidence, the authors reference Fama and French's 2012 paper with international equities, where they find that small caps had stronger returns than large caps, but large caps also were found to have strong returns over that period. It's just not as strong as small caps. But that their sample period was '89 to 2011, which is about the same period that's used in this paper, or it's out of sample period for this paper. But looking out over the longer period of the 1927 to 2013 period, there's little statistical evidence the momentum is much stronger among small caps. And also, which is probably most important, there's no period, a sample period where or a sample period with a reasonable length where momentum actually fails among large cap stocks. So large cap stocks have effective momentum returns, just they may not be as significant as small caps, but you can't say that large caps don't have solid momentum returns. So the authors note that a lot of the naysayers use the short only and small caps side together. And it's mostly a way to deny the practicality of using momentum strategies, because it's pretty expensive to short really small stocks. But the authors note that a way to do it would be to underweight small cap stocks or small cap losers in the portfolio, and you wouldn't necessarily have to short them, but you would be able to modify your portfolio allocation according to a long-only constraint and still be able to take advantage of the small cap losers potentially having a more significant loss than maybe large cap winners. Let's take a look at myth number 4. Momentum does not survive or is seriously limited by trading costs. And so it notes that the authors note the momentum strategies there's a lot higher turnover in the portfolio than other strategies, for instance, value strategies. And so higher turnover would mean that there are higher trading costs related to managing the portfolio, and so the returns of the momentum strategy would have to be high enough to cover those trading costs and to cover and the difference there would have to be significant enough to make it worth your while to use the strategy. And so here it looks like they're going to use real-world net of costs data to combat this myth. So they're referencing a study by Frassini, Israel, and Moskowitz, who are some of the authors of this particular paper, and they're using the real-world trading costs from AQR Capital's trades over, looks like the 98 to 2013 period, and across 19 developed equity markets. And they look at these trading costs across different strategies, for instance, momentum strategies, value strategies, and size-based strategies. And what they found was that the momentum strategy per dollar trading costs are quite low, and so then that means that the momentum strategies are able to be profitable when reducing the transaction costs. And so the authors note that in order to reduce the trading costs related to a momentum strategy, it's best to kind of trade patiently, break up the orders into small sizes, set limit orders instead of market orders, and also allowing for some tracking error rather than trading all the time to make sure you're following a particular benchmark to the T. And so when you do some of those trading strategies, you find that the trading cost isn't as much as maybe if you had just traded without taking into account all of these different strategies. So the authors note a couple papers here that maybe this myth had come from, both of them in 2003 and 2004, and they used estimates of daily or intra-daily data to show the transaction costs on the viability of the momentum strategies. But there's two differences that can explain the different results. And the first difference is that the trading costs that they use are for the average investor, which ended up being about 10 times as large as the common large institutional managers' costs. And in the FIM strategy, or the FIM trading costs, they used the large institutional manager trading costs. So there's a difference there between average retail investor, I suppose, and the institutional investor. And then the second difference would be that in the 2003 and 2004 studies, they didn't take into account some of the trading strategies that we noted before, like limit orders and not tracking the benchmark exactly, and so that would mean that their trading costs are probably a lot more than if they had done a better job of managing the transaction costs and the design of their portfolio. So the authors note that in the past, when the first size premium studies came out, that a lot of practitioners or studies said that it would be you wouldn't be able to trade the strategy, and so the premium that you could get from buying smaller stocks would be taken away by trading costs, and so it would be unprofitable to trade that strategy. And so just like the FIM study, it was found later that the trading costs that were used in the prior studies weren't realistic and were a lot higher than real trading costs that happen with large institutional investors, for instance, DFA or AQR. And so, an investor like DFA is smart enough to know strategies to reduce their trading costs. And it's been shown decades after these papers that small cap portfolios are able to trade and use those strategies profitably. And so, since the premium that we found for momentum strategies that in one of the prior tables is much larger than the size premium, and also the trading momentum the trading costs for momentum are slightly lower than for size, and that's because smaller caps are more expensive to trade, so loading up on small caps would be more expensive, and momentum isn't really geared towards that. So those two qualities would mean that momentum strategies would actually be a bit cheaper to trade than size strategies. Okay, so let's take a look at myth number 5. Momentum does not work for a taxable investor. And so this, of course, relates to momentum's higher turnover than other strategies, for instance, value. But the authors note here that higher turnover does not necessarily mean higher taxes. So let's look at some of the prior research that's looked into this. There's been papers by Israel and Moskowitz in 2013, some others in the same year, that show momentum actually has about a similar tax burden as value investing, even though it has 5 to 6 times the annual turnover. So this seems kind of odd at first look until we look at 2 facts. So let's see what those 2 facts are. The first fact they note is that momentum strategies typically have you hold on to winners but sell losers. So in that way you're holding on to winners longer, maybe getting a long-term capital gain instead of a short-term capital gain. And when you're selling the losers, then you get a tax deduction. And that's certainly an efficient tax strategy. So the second fact is that value strategies typically have very high dividend income exposure, which is typically taxed at ordinary rates rather than capital gain rates. But momentum, on the other hand, has a lower dividend exposure. So when taking into account these 2 facts, it ends up to where value and momentum strategies have about the same tax structure. And so since there's a higher premium for momentum strategies where we're making a higher return than value strategies, and similar tax rates, then we can say after-tax returns for momentum would be higher for value strategies. And here we have another twist that they want to mention. They note that the analysis above basically just took Ken French's data and used it to calculate after-tax returns. However, Israel Moskowitz's 2013 study did some tax-optimized versions of these strategies to design portfolios that would minimize taxes while also not drifting away from the momentum strategy too far. And so they found that tax optimization is a lot easier to implement with capital gains than it is through dividend, and that makes sense because I suppose you have control over when you buy or sell companies to get those capital gains, but not necessarily when you're going to receive a dividend. And so delaying selling shares in order to get long-term status instead of short-term status could have a pretty significant effect on the after-tax returns, and it wouldn't really change much along the pre-tax returns of the stock. But they note the only way to avoid paying income tax on dividends is to hold non-dividend paying stocks, and to do that would be sort of against a value strategy, because your dividend yields for value companies are typically higher than growth companies, which will be characteristic of a momentum strategy. So all that to say, it's probably easier to implement an efficient tax minimization strategy using momentum than it is to do it with value stocks. And so the bottom line is that momentum survives taxes, and tax burden roughly equal to or smaller than lower turnover strategies such as value. And so when you look at after-tax returns, since momentum strategies return more than value strategies, then we could say the after-tax returns for momentum strategies are more than those of value strategies or other factor-related strategies. And so the myth related to momentum not being good for the taxable investor can be considered debunked.